Imagine two friends. Let's call them Olivia and Hannah. They're 29 years old. They grew up in the same house, went to the same public school, attended the same state university. They both studied business. They both graduated with similar student loans. Today, they both work as marketing managers, earning roughly $78,000 a year. They even bought condos in the same building downtown. Same floor plan, same square footage, same monthly HOA fee, same gray car parked in the garage. On paper, their financial lives are almost identical. But over the next 30 years, Olivia will quietly transfer somewhere between $200,000 and $250,000 more to banks, insurers, landlords, and lenders than Hannah will. She won't gamble it away. She won't lose it in a startup that fails. She won't burn it on luxury vacations. She will simply pay more for the same life. Because one invisible 3-digit number attached to her name is 635 instead of 765. That difference is what I call the credit premium, the invisible surcharge that most people never calculate. We obsess over income taxes. We complain about inflation. We argue about interest rates on the news. But almost nobody sits down and calculates how much their credit score will cost them over a lifetime. And in the high-interest environment of 2026, that number is no longer trivial. It's massive. If you've ever felt like you're doing everything right, paying your bills, working hard, staying responsible, but still feel like the system prices you differently, this conversation is for you. Because your credit score is not a measure of your character. It's not even a measure of your wealth. It's a pricing algorithm that determines how expensive your future will be. Let's start somewhere unexpected. The modern credit score is younger than many people watching this video. The FICO scoring system in its current form was introduced in 1989. Before that, lending decisions were made by human underwriters reviewing paper files. That old system had bias. It had inconsistency. It had serious structural problems. The new system replaced human bias with algorithmic efficiency. But efficiency doesn't mean neutrality. It means standardization. And once you standardize risk, you create tiers. Olivia and Hannah are both applying for a $400,000 mortgage. Hannah's 765 score qualifies her for a 6.1% interest rate. Olivia's 635 score qualifies her for 7.6%. 1.5% doesn't sound dramatic. It sounds like a rounding error. But stretch that across 30 years. On that mortgage, Olivia will pay well over $100,000 more in interest. Same building, same view, same elevator, different algorithm. Now take that $100,000 and ask a more dangerous question. What if that money had been invested instead? What if it compounded at 7% annually over 3 decades? That $100,000 could quietly turn into $500,000. So the real cost of a weaker credit score isn't just higher interest, it's the lost future. It's the investment account that never existed. It's the optionality that never formed. And the mortgage is just the beginning. When Hannah calls her insurance provider, she receives a lower premium quote than Olivia. They drive the same vehicle. They live in the same zip code. They have identical driving records. But the insurer's actuarial model says individuals with lower credit scores statistically file more claims. So Olivia pays more, not because she's reckless, because she's priced differently. This is where things become unsettling. Your credit score is no longer just a borrowing metric, it's a behavioral proxy. Landlords use it to screen tenants. Utility companies use it to determine security deposits. Cell phone carriers check it before offering installment plans. Certain employers in finance, government, and defense sectors review it during background checks. Imagine being the more qualified candidate for a job, but losing the offer because your credit dipped during a medical emergency 3 years ago. That's not hypothetical. It happens. The score has quietly mutated from a lending tool into a reputation score. And here's the paradox. The credit score does not measure wealth. Hannah could have $10 million sitting in cash and still damage her score if she mismanages revolving credit. Olivia could be living paycheck to paycheck, juggling balances, but as long as she never misses a payment and keeps utilization low, her score can remain strong. The algorithm rewards participation in debt, not absence of it. It rewards predictability. If you have never borrowed, you are invisible. If you borrow and repay consistently, you are measurable. This is why people sometimes pay off a car loan early and see their score drop slightly. When you close an account, you reduce active data. The system prefers active, ongoing participation. It doesn't punish you morally. It adjusts your profile based on future profitability. That's uncomfortable to hear, but it's accurate. Now let's break down how this number is actually constructed. Roughly 35% is payment history. 30% is credit utilization. 15% is length of credit history. The rest includes credit mix and new inquiries. Payment history is simple in theory. One missed payment can linger on your report for 7 years. But utilization is where optics dominate reality. If Olivia has a credit card with a $5,000 limit and she uses $2,000, her utilization is 40%. That signals strain. If Hannah has a $20,000 limit and uses the same $2,000, her utilization is 10%. Same spending, different perception. Credit scoring is partly mathematics, partly theater. It rewards the appearance of financial breathing room. Now let's add another layer. Credit advantage is often inherited. Hannah's parents added her as an authorized user to a credit card they've maintained for 20 years with perfect payment history. She never used it. But the account age and payment record transferred to her report. She entered adulthood with a score in the mid-700s. Olivia's parents struggled financially. No one added her as an authorized user. She started from scratch. Same intelligence, same ambition, different starting point. This is one of the quiet mechanisms of structural inequality, not through cash transfers, through credit lineage. Now consider what happens when something goes wrong. Olivia experiences a medical emergency. She misses 2 payments. Her score drops by 80 points. She eventually catches up. But when she refinances her car loan the following year, she's offered a rate 3 percentage points higher than Hannah. Over 5 years, that difference alone costs her thousands. Multiply that pattern across mortgages, credit cards, personal loans, insurance premiums, and rental deposits. It compounds. This is what I mean by invisible tax. Now let's talk about the industry that claims to fix this. Credit repair companies promise miracles. Most overpromise. But the underlying legal mechanism they rely on is real. Under federal law, information on your credit report must be accurate and verifiable. If an item contains inaccuracies, you have the right to dispute it. If the Bureau cannot verify it properly, it must be removed. This isn't magic, it's process. And understanding that process can protect you. There's also a philosophical argument that always surfaces. Some people say, avoid debt entirely. Live cash only. Opt out. In theory, that sounds clean. But in practice, in modern America, operating without credit creates friction. Higher rental deposits, limited housing options, insurance surcharges, loan denials. For most people, complete abstinence from credit isn't liberation, it's restriction. The pragmatic approach isn't to reject the system, it's to understand it. Automate every payment so you never miss one accidentally. Keep utilization below 30%, ideally below 10%. Request credit limit increases periodically to widen your available capacity. Preserve your oldest accounts to maintain history length. Monitor your reports annually for errors. These actions are not about impressing banks. They are about reducing lifetime friction. Because cheaper capital equals retained capital, and retained capital compounds. Here's the part most people miss. You don't need a perfect credit score. You need a strategically strong one. The difference between 620 and 760 over a lifetime can easily exceed $200,000. Not because you spend differently, but because you are priced differently. That's the structural reality. Olivia and Hannah will likely continue earning similar salaries. They'll celebrate holidays together. They'll attend family gatherings. From the outside, no one will notice the divergence. But in their late 50s, Hannah's investment accounts will be meaningfully larger. Not because she worked harder, but because she paid less to access money. This isn't about shame. It's about awareness. Your credit score is not your identity. It's a leverage tool. You protect it not for ego, but for efficiency. Because every extra dollar paid in interest is a dollar that never compounds for you. And compounding over decades is where freedom quietly forms. The banks profit from confusion, from missed payments, from high utilization, from disorganization. But once you understand the algorithm, you become less profitable to them. Lower interest, lower premiums, better terms. That's the sweet spot. If this made you realize you've been playing a financial game without seeing the full rulebook, share it with someone who thinks their credit score is just a number. It's not just a number, it's a pricing tier. And over a lifetime, pricing tiers determine outcomes. Protect it strategically, use it intelligently, and make sure the next 30 years are priced in your favor. I'll see you in the next one.